Okay, premium members and I guess public members if I ever decide to make this video public and not behind the premium subscription, like if I end the mentorship again. Here is a comprehensive breakdown of the Mark II model as far as um, a series of events goes. So this isn't necessarily a breakdown on how to trade the Mark II. That's going to be on another video. But this is going to be a video on essentially what the Mark II is in a nutshell. And in this video, we're going to discuss how you can apply it to higher time frame and lower time frame. I'm going to go through a few examples and trying to be optimistic and careful here. Likely we'll get knocked off even worse than before. I don't know what Stoic is going to call it this time. He called it SBS last time, and it's horrible. But yeah, this is the actual Mark II. I tried to make this video in the Invisible Zone Volume 3, and it just came out terribly, unfortunately. So really sorry for that, guys. But I do expect this one to be better. So let's get into it. The Mark II, for the Mark II, the very first thing you're going to need is to, sorry, that probably just scared the hell out of you if you're watching with headphones. Okay. So first things first, you're going to need to know structure. If you don't know structure, premium members, and by this time, if it's public, then everyone else as well. There's going to be videos on candlestick structure and then market structure. That's core material that you need to know before learning the Mark II. So if you're watching this and you haven't watched the core material, get the hell out of here, go watch that, and then come back. Don't come back until you watch it, because this won't make any sense to you. You will get it wrong. You'll end up making a horrible trading model and profiting probably a lot of money off of YouTube and new mentorship from it. So maybe you should actually stick around and watch it. But anyways, so you got to know market structure. And I'm just going to go ahead and draw out some market structure real quick. Right here. Sorry about that. Anyways, drawing out the market structure still. We have a big flip down here, and we have a big flip up here. We have a swing up to here. Golly, could I have drawn that worse? Hang on. We have a swing up here. Perfect, right? And then between here and here, if you know anything about market structure, you know that we've either got to do a flip down or a swing up. What we end up getting is a quick flip right down. And where do we flip into? None other than the Mark II, which is this level right here. And then we shoot up and continue to make higher lows the entire time until we hit our objective, which is right up here. So this is on the daily time frame. The Mark II is essentially the space between the flip low and the tap back. So if we're talking about it in a bullish trend, and if you want to turn your phone upside down to learn what it means in the bearish trend, people are always asking about that. I can try to give examples. I just wanted to let you know that it's literally the same thing in both directions. Essentially, the Mark II is going to be whenever you have a flip, it's going to be the low, if we're talking about bullish, right? If you have a flip down and then a flip back up, so you were trending down, and then once you flip up, it's the spot that took you from the low, the tap into that flip zone. Let's get rid of these drawings. The Mark II is the spot that takes you from inside of this flip zone to back outside of the flip zone over the high that brought you in. So how to identify the Mark II? Step one, look for closure up out of the swing, okay? Look for closure up out of the swing, not the swing, the flip. Look for closure up outside of the flip. It wouldn't have been a flip if there wasn't closure, so it's kind of an oxymoron, but look for the closure that makes the flip, right? And it looks like the closure that makes the flip is right here. We're going to go ahead and cover our box out right there. So we have two kinds of Mark IIs in general on almost every setup that works at least. One is going to be the initial Mark II, which is right here. And what that means is we have the closure above this line. Let me just leave this box here for simplicity's sake for now. Actually, no, I'm just going to put it here. But we have the closure above this line. We then come back in and tap this low. And after tapping that low, we go and take the high right there. So essentially, and if it didn't happen in that perfect order, then it's this. It really doesn't matter. Either way, it's about the order of operations is important, but this, which candlestick was it right here isn't really important right now. Essentially, you're looking for the closure above that previous high, that protected high. When you close above that protected high, that makes it a flip up. After you flip up, we are looking for where does price tap down into and then go and travel up above that high from. So in this instance, I think it would be this is the high, we go up to this high, we come down to this low, and then we go travel through this high again. So this is the Mark II right there. Now, once we go ahead and come below that Mark II and we get entry model confirmation from the lower time frames, because this is the daily, we would then be targeting whatever high we had created prior to touching the Mark II. So it would be this high. So we come up and close, up above here, we put in a high. After closing, we put in a low that goes and runs that high. And then later we come and take that low out and we go and run the high that we had just come from there. So we put in this high prior to going to this low. After putting in this high prior to going to this low, we then go sweep this low out and then go take that high. So in essence, if you could find, let's say, a trading entry model like right here, you would go ahead and cover your low and you would target the high that you had come from right here. Now, on a broader scale, you're going to be seeing the second touch of the Mark II, especially on big setups like this, especially when you're flipping straight down, really running without giving people a chance to get in. You're flipping straight down below this. So what happens here? We have a swing, or a flip up. We have price come back in. Price puts in a high here. We have price come back in. We have price go back out. When we go below this, we will be targeting the high that we came from, which is up here. Now I'm talking about structural highs. Why is this a structural high? This is a structural high because this is the first time that we get a valid swing or a valid pullback this entire time. I'm not considering this a pullback because this is a gap up. So closure below this, I don't care about it. I don't like it. I essentially just see this entire thing as a candle here, basically from here to here, right? Or from here to here. So in my mind, this is a gap. This is not a swing. This is not a pullback. This is not a structural swing. This is just all one swing up, okay? And then that means that this is the high that we came from. So we go all the way up, we put in the high point. That's the highest point we put in before going and taking the Mk.II. Now, once we take the Mk.II, we have a flip down. How do we avoid trying to short here on the Mk.II to the short side? Well, simply put, there is not a Mk.II. I'll tell you why there's not a Mk.II. Because if you're looking for a Mk.II, you need to have price go from the low to a high of some sort and then back below that low. If we had a low and then came back into this flip down and then we went and left the range again and went below here, then once we came back up, we would be looking for opportunities for shorts from the Mk.II, from sweeping the Mk.II back below the low that we came from. But that's not what happened. What happened was we made a closure and we went straight back up, which is a very bullish confluence. So make our flip straight back up. We start marching along. We make higher low, slightly lower low right here, but then we rip right back up and get to our target. I mean, at this point, you're so close, it's like money in the bag. So now, where is our current Mk.II? Well, on the daily, we have an initial Mk.II. Looks like around here, right? Because we come up, we put in our high, we go ahead and we go ahead and make a low. We go up above the high right here. So when we come below this low, we anticipate to get above this high. Again, we close, we pull back in, we tap, we take this high, we come back and take the low that took that high, we go take the high of that candle, okay? So now on a broader scale, once again, where is the Mk.II? The Mk.II is down here. Now, right behind the Mk.II, there's also this SNDR. So a lot of times, if you're a Mk.II trader like me, you don't just want to see if the SNDR is fully mitigated, like this, at the 50% or greater. You aren't necessarily anticipating just to sweep this out and then go up. You're more likely, now that you've used 50% of the SNDR or the breaker, whatever you want to call it, you're going to anticipate the sweep of the SNDR to be greater liquidity to give a greater reaction. So that's, in essence, Mk.II. Let's go over the example from the Mk.II today. Very clean example. We have here, let me mark out structure real quick on the 15-minute. Low, high, flip down, flip up. So high, low, high, flip down, low, high, low, flip up, right? Flip up goes all the way up to here before we get a pullback. Now let's go ahead and mark out where did we close above and identify a flip on the 15. That was right here. Where does price tap into before going higher? After the body closure, right here. Where do we expect price to retrace to and then give us strong reactions from? The Mk.II. Where would we anticipate price to go? To the high that we came from. That is the Mk.II model. Let's go to the 2 hour. Let's find an example on the 2 hour real quick. I don't even know, bro. Hang on. Is this a flip? I guess this isn't a very good example. I didn't think this through. I should have found one. I didn't do what the other YouTubers do and cherry pick. That's probably why I'm not popping and famous, right? Where does this flip down? The 2 hour flips down right here. No, it doesn't do it either. I know that there are 2 hour examples. It's not just on the daily. Hang on. This is a crummy example, but look, we close above this. This low runs this little high, and you could even consider it running this little high, even though that wick happens prior to. Once we go below that and then consolidate, manipulate down with this wick below these initial lows and get an entry model on a lower time frame, we can go and take the high that we came from. Not a very good example. Let's go ahead and just draw out a diagram for starters. Let me go back to the daily. It happens a lot more on the 1 minute and the 15 minute. So essentially, you are trending down. We're talking about a bullish example. And then let me draw a diagram of a bearish example because I already showed candlesticks of a bullish example. So let's talk about the bearish example. So we're trending up right now. Trending up. Trending up. And then boom, we flip down. Once we flip down, we make this little tap right here. Then we go lower. Once we come back up, this is the Mk.II. This is the continuation down. The Mk.II level is where the highest point that we tapped into after the closure of this flip right here. Okay? So I get a lot of questions. One of the questions I get the most, I think the question I get the most is, Magma, does the Mk.II have to be inside of the flip zone? No, it does not. Is it okay if it's inside of the flip zone? Absolutely. Does it have to be inside the flip zone? No. So let me show you the example in the 15 real quick, actually. Here is your flip zone. Here is your Mk.II. Notice how we're taking longs without getting into this zone. We ended up touching by hair into the zone here, and then now we're, going crazy, right? But the trade we took today for 95 points up to this news high right here, this reaction came from this Mk.II, completely out of the zone. We didn't touch the zone. We were still able to get a 100-point trade. You don't have to come down into the zone for the Mk.IIs, okay? Let's go over one more example. One more example will be good. I think that I took some shorts that I might have used the Mk.II on. I know that I took shorts, actually, earlier on, like last week or the week before, that used the Mk.II. Yeah. So here's an example. We have a 15 flip down right here because after the gap we establish highs, lows, higher high, low, higher high, lower low. So we're gonna go ahead and draw out our flip right here, or let's just call it right here. Okay. Now once we close below, this is a fractal example. Golly, can I find one? Well, this is actually a really good opportunity to talk about this real quick. So not only is it a bearish example, it's a fractal example. We wick hard below these lows, but we don't close. We still make a fractal Mk.II right here. It's not always going to be perfect, okay? So the same concept still applies on some occasions if you have a bias along with it, like how we had a 2-hour bias of shorts, right? We're not waiting for it to be perfect every time. It's not always going to be cookie cutter, right? But we get below this, we come back up, and we definitely closed hard on the 1 minute here. We get below this, we come back up, and then this high sends us below this low. So when we come above this high, we anticipate to go below this low. Capiche? Let's see if there's a 15-minute example right here as well. I think this is a flip up. I don't know if there's an example here, I'm just looking. So after this closure, let's just call this the low, right? We've got a low, this is an initial Mark II. We have the close up, we come down, we go higher, we come down below it, we go higher, we come down below this, we go higher, we come down below this, we go higher. So does the Mark II have multiple uses? On some occasions, yes, absolutely. It can have many uses. This is an example of it having 3 or 4 uses. So back to the diagram one more time. I'm going to draw it on the bullish side now. We are trending up. Oh, sorry, wrong. We're trending down. If we want a bullish Mark II, we flip up, we tap, we go, we come back, we get below that tap, and we go higher again. That's the Mark II. It's not the same as an SNDR scalp because it doesn't have to come into the zone. It's not based on an SNDR. Do I trade SNDR scalps? Yes. What is an SNDR scalp? I'll cover that in another video, but in essence, if you've got a 1 minute swing here that has a 5-second swing here right before leaving, you would look at the 5-second, you would take the tap of the SNDR, you would target the high that you came from. And essentially, a lot of the times, the Mark II and the SNDR tap scalp become friends later because you have the Mark II here. Why is it a Mark II? Because it went and took the high that it came from after leaving the range on a flip specifically, not on a swing, on a flip. Come down, go up. Later on, once we come down below this, we're expecting longs. If we get the entry model, if the higher time frame remains bullish throughout all of that it does up here, and if it does some big structural flip, we're not looking at the Mark II trying to trade it. We're going to talk about that in how I execute on the Mark II video, but this was just a short and simple explanation as to what the Mark II is to give clarity. So if you guys have been trying to use like SBS and you've just been like, what the hell, this is just another scam, I'm sorry that I was gone for so long and left you with the bad man. Here is the actual model. So go ahead and backtest the hell out of it on the 15, on the 1, on the daily, on the 2 hour, on the 144, on the 12, whatever it is that you use, just backtest it to death. I have backtested the Mark II since 2012, 2 times on FX Replay. That's not a joke. So I would highly encourage you to do the same. Don't just be on the tit. Don't rely on other traders. Only you can help you. And most importantly, there's no holy grail to trading. There's no mechanical strategy that anyone here knows of. Otherwise, you'd be a billionaire. So this is going to take intuition. It's going to take practice and expertise. You have to get that through backtesting. And the only way you're going to be able to be profitable is if you master your mindset, if you master your psychology, your risk management. All of that on how you make your decisions as a trader is going to be just as important as your model. This is a very accurate model. It provides a lot of great opportunities. If you don't have experience in the market and you don't know how to actually use it properly in a non-mechanical setting, in a discretionary setting, then you're going to get ripped up. So if you're here looking for mechanical setups and you don't want to be a discretionary trader, I say this with like genuine concern, not in like a, oh, I feel bad for you way. You have to realize that you're not going to find that. And you have to be willing to accept that you are either never going to be a profitable trader or you are going to learn how to use discretion in trading to be profitable. That is it. If you're watching this and you're like, oh, I just found a mechanical strategy, actually, this guy doesn't know, and I'm going to make an NDA. I've been there, dude. I've been there. I've talked to some big wigs and told them about this and that thing and tested it and gotten far into the conversations and wanted to sell it for big money and then realized, oh shit, wait, this only works randomly on the second quarter of every contract. The second half of every quarter, second half of every contract, right? So, and it's not every single one. It's actually random when it does work. And sometimes Mondays and Thursdays don't work, and sometimes they're the best days of the week, right? And you realize, okay, hang on. There still is discretion in trying to figure out when I would turn this damn thing on. So you're gonna have to learn to be discretionary. If you don't, then if you don't want to do that, that's fine. You need to go do something else. And that's okay. It doesn't make you a failure. It just means that this isn't the thing for you. You wanted to come up with a passive trading method. I would suggest just waiting for big dips and recessions, saving money and putting money into the stock market and real estate. You're going to make passive income that way as well. But this is not the thing for you. You're even on bots, even on mechanical strategies, you're going to have to use discretion and know when and when not to, and that's always going to change. It's not going to be a thing where, you just set a specific time for your bot or your mechanical strategy to take executions, and then it stays that way forever. It's going to change in a week, and that's just how it works. But anyways, this is the Mk.II from a mechanical standpoint, and we're going to get into, in the next coming videos, how I trade it, how I apply my own discretion, some of the nuances I've learned in my experience with backtesting and forward testing it, and we'll also talk about my other trading models in these videos as well. But just wanted to get this one knocked out, and I'm going to go make some delicious tacos now. Hopefully you guys have a good night. Be safe. We're at all-time highs, and the market is being absolutely bonkers right now. We just had a 90-point gap on Asia. I don't even know. Maybe it was like those earnings, like late reaction or something, but just be safe and spend this time, practicing and learning rather than trying to force the market to give you some money right now. Let the market come to you. See you guys in the next one.